Trading losses are often explained away by external factors such as difficult market conditions, sudden volatility, or a lack of reliable information. While these elements do play a role, they are rarely the primary cause of consistent underperformance. In most cases, the real issue is internal, a single recurring mistake that appears in different forms, but originates from the same underlying weakness. This mistake is particularly dangerous because it is not always obvious. It blends into everyday decision making and becomes part of the trader's routine, making it difficult to recognize and correct. At the center of this problem is inconsistency in execution. Many traders have some form of a plan, whether written or implied, that outlines how they intend to approach the market. However, the existence of a plan does not guarantee its application. The real challenge lies in following that plan with precision. In practice, execution often deviates from the original structure. Entries may be taken slightly earlier or later than intended, exits may be delayed in the hope of better results, and risk parameters may be adjusted based on recent outcomes or emotional responses. Each of these deviations may seem minor in isolation, but together they create instability. Over time, this inconsistency undermines the entire trading process. This core mistake does not always present itself in a single, easily identifiable form. Instead, it manifests in a variety of behaviors. A trader might enter a position without waiting for full confirmation, convinced that the setup is close enough. In another situation, position size may be increased after a series of losses in an attempt to recover quickly. There may also be a tendency to hold on to losing trades longer than planned, hoping the market will reverse and validate the decision. On the surface, these actions may appear unrelated, but they are all expressions of the same underlying issue, a lack of disciplined adherence to a defined process. One of the reasons this mistake persists is that it does not always produce immediate negative consequences. In fact, there are times when breaking the rules leads to a profitable outcome. A trade taken without full confirmation may still move in the anticipated direction. Increasing position size might result in a quick recovery after a loss. Holding onto a losing trade could occasionally lead to a reversal that turns the position into a profit. These outcomes create a false sense of validation. They reinforce the belief that flexibility or instinct can replace structure. As a result, the behavior is repeated, even though it is fundamentally flawed. Over the long term, the negative effects of inconsistency outweigh these occasional successes. Another factor that contributes to the persistence of this issue is the difficulty of accurate self-assessment. Without detailed records of trades' decisions and outcomes, it becomes nearly impossible to identify patterns of behavior. Many traders evaluate their performance based on individual trades rather than a series of trades. A loss is often attributed to bad luck or unfavorable market conditions, while a win is seen as confirmation of skill. This fragmented view prevents a deeper understanding of what is actually happening. The lack of structured analysis means that the same mistakes are repeated without recognition. To address this problem effectively, a shift in focus is required. Instead of concentrating on the outcome of each individual trade, attention must be directed toward overall behavior. The key question is not whether a trade was profitable, but whether it was executed according to the plan. By consistently evaluating decisions in this way, patterns begin to emerge. It becomes possible to identify specific actions that lead to unfavorable results, such as entering too early, adjusting risk impulsively, or failing to follow exit rules. This level of awareness is essential for making meaningful improvements. Honest evaluation is a critical part of this process. It requires acknowledging mistakes without justification or excuse. This can be challenging, as it involves confronting habits and tendencies that may have been reinforced over time. However, without this level of honesty, progress is limited. Recognizing recurring patterns allows for targeted adjustments, making it possible to replace inconsistent behavior with disciplined execution. It is also important to understand that the problem is not the market itself. Markets are inherently uncertain and constantly changing, but they operate within a structured framework. The real issue lies in how decisions are made within that environment. When actions are inconsistent, results become unpredictable. When actions are consistent, outcomes become more stable and measurable even if they include losses. Ultimately, Identifying the core mistake behind consistent losses is the first step toward improvement. By isolating the root cause, lack of disciplined execution, it becomes possible to develop solutions that address the problem directly. This may involve refining the trading plan, implementing stricter rules, or improving the process of review and analysis. Whatever the method, the objective remains the same: to create consistency in behavior. The key insight is simple but powerful. Success in trading is not determined by the ability to predict the market, but by the ability to interact with it in a structured and disciplined way. When the focus shifts from outcomes to execution, the foundation for long-term improvement is established. Over time, this leads to greater stability, clearer decision-making, and more consistent performance. A single mistake in trading rarely causes significant or irreversible damage. Most trading accounts are not destroyed by one bad decision, but by a pattern of repeated errors that accumulate over time. This is where the real danger lies. When the same mistake is made consistently, no matter how small it may seem in the moment, its impact compounds, gradually eroding both capital and confidence. Understanding this compounding effect is essential for identifying why progress often feels slow or even non-existent despite continued effort. Compounding is commonly associated with growth, where small, consistent gains build into meaningful returns over time. However, this principle works equally in the opposite direction. Just as disciplined execution can lead to steady improvement, repeated mistakes can lead to steady decline. The key issue is not the size of any single error, but the frequency with which it occurs. Even minor deviations from a trading plan can have a significant cumulative effect when repeated across dozens or hundreds of trades. Consider the impact of entering trades prematurely. On an individual level, entering slightly early may not seem like a major issue. The trade might still work, occasionally reinforcing the behavior. However, over time, these early entries can reduce the overall win rate. Trades that would have been valid with proper confirmation become unnecessary risks. As this pattern continues, the statistical edge of the strategy begins to weaken, not because the strategy itself is flawed, but because it is not being executed correctly. A similar effect can be seen when position size is increased after a loss. This behavior is often driven by the desire to recover quickly, but it disrupts the consistency of risk management. A larger position size means that losses have a greater impact on the account. Even if the next trade is successful, the inconsistency in risk creates instability in performance. Over time, this leads to uneven results and increases the likelihood of significant drawdowns. Holding on to losing trades is another common mistake that contributes to negative compounding. When a trade moves against the planned direction, the disciplined response is to exit according to predefined rules. However, the tendency to hold on, hoping for a reversal, extends losses beyond acceptable limits. While this may occasionally result in a recovered trade, more often it leads to larger losses that outweigh previous gains. Repeating this behavior over multiple trades accelerates the decline in account balance. Beyond the financial impact, the psychological effects of repeated mistakes are equally significant. As losses accumulate, confidence begins to decrease. This loss of confidence does not remain isolated, it influences future decisions. Traders may begin to hesitate, second-guess valid setups, or abandon their plan entirely. In other cases, frustration may lead to impulsive actions such as overtrading or taking unnecessary risks. This creates a feedback loop where poor decisions lead to losses, and losses lead to even poorer decisions. Over time, discipline becomes harder to maintain, and emotional responses become more dominant. Another important consequence of inconsistent execution is the distortion of performance metrics. A trading strategy can only be evaluated accurately if it is applied consistently. When rules are followed sporadically or adjusted based on emotion, the results no longer reflect the true effectiveness of the system. A potentially profitable strategy may appear unprofitable simply because it is not being executed as designed. This makes it difficult to determine whether the issue lies in the strategy itself or in the way it is being applied. Without clarity, meaningful improvement becomes nearly impossible. One of the reasons the compounding effect is often overlooked is its gradual nature. There is rarely a single moment where the account experiences a dramatic collapse. Instead, the decline happens slowly, trade by trade. This makes it difficult to identify the exact cause of the problem. Losses may be attributed to market conditions or bad luck, while the underlying pattern of mistakes goes unnoticed. By the time the issue becomes clear, significant damage may already have been done. Breaking this cycle requires a deliberate and conscious effort to interrupt the pattern of repeated mistakes. The first step is not only identifying the mistake, but also understanding how it affects overall performance over time. Recognizing that small errors can accumulate into large consequences creates a sense of urgency and importance around disciplined execution. It shifts the focus from short-term outcomes to long-term consistency. The ultimate objective is to replace negative compounding with positive compounding. This means ensuring that every trade is executed according to a defined process, with consistent risk management and clear decision-making. When discipline is applied consistently, small improvements begin to accumulate in a positive direction. Over time, this leads to greater stability, more reliable performance, and a stronger foundation for growth. In the end, the difference between success and failure in trading is often not determined by strategy alone, but by the ability to execute that strategy consistently. By understanding how mistakes compound over time, it becomes possible to take control of the process and move toward more sustainable results. Eliminating a recurring mistake in trading requires more than simply recognizing that it exists. Awareness is only the starting point. Real improvement comes from building a structured system that actively prevents the mistake from happening again. Without such a system, even the most well-understood problems tend to resurface, especially under pressure. The goal is to shift from relying on willpower to relying on a process that enforces discipline automatically. The first step in building this system is defining clear and precise rules for every aspect of trading. Vague guidelines leave room for interpretation, and interpretation often leads to inconsistency. Each rule must be specific, measurable, and easy to verify. Entry criteria should clearly define what conditions must be present before a trade is taken. Exit conditions should outline exactly when and why a trade will be closed, whether in profit or loss. Position sizing must be fixed based on predefined risk parameters, and risk management rules should establish clear limits on how much can be lost on any single trade or over a series of trades. When rules are this clearly defined, decision-making becomes more objective and less influenced by emotion. Once these rules are established, implementing a checklist becomes a powerful tool for consistency. Before entering any trade, each condition must be reviewed and confirmed. This process forces a pause between analysis and execution, reducing the likelihood of impulsive decisions. If even one condition is not met, the trade is simply not taken. This removes the temptation to justify borderline setups or act on incomplete signals. Over time, the checklist becomes a habit, reinforcing disciplined behavior and ensuring that every trade aligns with the system. Automation can further strengthen this structure by reducing the need for real-time decision-making. Tools such as predefined stop, loss, and take-profit orders ensure that risk is controlled from the moment a trade is entered. This eliminates the possibility of adjusting exits based on emotion while the trade is active. For example, a stop loss that is placed automatically cannot be moved out of fear, and a take-profit level cannot be ignored out of greed. By embedding these parameters into the execution process, the system protects itself from emotional interference. Another important element of this system is limiting exposure. This includes controlling both position size and the total number of trades taken within a given period. By maintaining consistent position sizing, the impact of any single mistake is kept within acceptable limits. At the same time, reducing the number of trades prevents overexposure to low-quality setups. This selective approach creates a more stable trading environment, where each decision carries weight and is aligned with the overall strategy. It also reduces mental fatigue, making it easier to maintain focus and discipline. Accountability mechanisms play a crucial role in reinforcing the system. Keeping a detailed trading journal allows every trade to be recorded, including the reasoning behind it, the conditions that were met, and the outcome. Regular review of this journal helps identify patterns of behavior, particularly deviations from the plan. When mistakes are documented and revisited, they become easier to recognize and correct. Setting performance benchmarks can also provide structure, allowing progress to be measured over time. The purpose of accountability is not to judge outcomes, but to ensure that the process is being followed consistently. It is equally important to address the underlying causes of the recurring mistake. Surface level corrections may provide temporary improvement, but lasting change requires understanding why the mistake occurs in the first place. If impatience is the root cause, adjustments may be needed in the trading schedule, such as reducing screen time or focusing only on specific sessions. If overconfidence is the issue, stricter risk controls and limits on position size may be necessary. By targeting the source of the behavior, the system becomes more effective in preventing it. Simplicity is a key factor in the success of any trading system. Complex systems with too many rules or variables are difficult to follow consistently, especially under pressure. This increases the likelihood of errors and deviations. A simple, clear framework is far more effective because it can be applied reliably in all conditions. The objective is not to create a perfect system, but a practical one that can be executed without confusion. By implementing a structured system that includes clear rules, checklists, automation, controlled exposure, and accountability, the likelihood of repeating the same mistake is significantly reduced. This approach removes reliance on emotion and replaces it with consistency. Over time, this consistency leads to more stable performance and a stronger foundation for growth. Discipline is one of the most important qualities in trading, yet it is also one of the most difficult to maintain. It is often misunderstood as simply having control over emotions, but in reality, discipline is the ability to follow a clearly defined process regardless of what is happening in the market or how one feels in the moment. It is the bridge between having a plan and actually executing it consistently. Without discipline, even the most effective strategy will fail, and recurring mistakes will continue to appear. One of the most effective ways to reinforce discipline is through the development of a structured routine. A consistent daily process creates stability and reduces uncertainty, which are two major sources of emotional decision-making. This routine should include dedicated time for market analysis, where conditions are evaluated and potential setups are identified. It should also involve trade planning, where specific criteria for entries and exits are clearly defined before any action is taken. Execution should follow this preparation without deviation, and the day should end with a review of all trades taken. By repeating this process daily, trading becomes less reactive and more controlled, making it easier to maintain discipline over time. Setting clear limits is another critical component of maintaining consistency. These limits act as boundaries that prevent impulsive behavior from causing significant damage. A maximum daily loss, for example, ensures that trading stops once a certain threshold is reached, protecting both capital and mental clarity. Similarly, limiting the number of trades taken within a session helps prevent overtrading, which often results from frustration or the desire to recover losses quickly. Predefined risk per trade is equally important, as it ensures that no single decision has an outsized impact on overall performance. These limits create a safety framework that supports disciplined behavior even in challenging conditions. Tracking performance plays a vital role in reinforcing accountability. A detailed trading journal allows every decision to be recorded, including the reasoning behind each trade, the conditions that were present, and the outcome. Over time, this record becomes a valuable source of insight. Patterns begin to emerge, highlighting both strengths and areas that need improvement. Regularly reviewing this information helps reinforce positive behavior while identifying and correcting negative habits. Without this level of tracking, it becomes easy to overlook recurring mistakes or misinterpret results. Mental preparation is another factor that significantly influences discipline. Before engaging with the market, it is important to establish a focused and objective mindset. This involves removing distractions, setting clear intentions, and approaching trading with a calm and neutral perspective. When the mind is cluttered or emotionally charged, decision-making becomes reactive rather than structured. Taking time to prepare mentally helps create the conditions necessary for consistent execution. It ensures that decisions are based on the plan rather than on impulse or external pressure. A key shift in perspective is prioritizing consistency and execution over short-term results. Many traders judge their performance based on whether a trade was profitable, but this approach can be misleading. A profitable trade that violates the rules reinforces bad habits, while a losing trade that follows the plan strengthens discipline. Over time, it is the quality of execution, not the immediate outcome, that determines long-term success. A series of well-executed trades builds a reliable process, while inconsistent behavior leads to unpredictable results, regardless of occasional profits. Accepting losses as a normal part of trading is also essential for maintaining discipline. Losses are unavoidable, and attempting to eliminate them entirely often leads to poor decisions, such as moving stop loss levels or avoiding valid setups out of fear. Instead, losses should be viewed as part of the system, managed within predefined limits. When risk is controlled and expectations are realistic, losses become manageable and less emotionally disruptive. This acceptance allows for clearer thinking and more consistent adherence to the plan. Reinforcing discipline is not a one-time effort but an ongoing process. It requires continuous attention, regular evaluation, and a willingness to adjust when necessary. Over time, disciplined behavior becomes more natural and less forced. Actions that once required conscious effort begin to feel routine, and consistency becomes part of the trading identity. Ultimately, discipline and consistency work together to create stability in trading. By following a structured routine, setting clear limits, tracking performance, preparing mentally, and accepting losses, the process becomes more controlled and predictable. This does not guarantee immediate success, but it builds a strong foundation for long-term improvement. As discipline strengthens, recurring mistakes diminish, and performance becomes more consistent over time. The final stage in developing as a trader is the transition from reactive behavior to a sustainable, professional approach. This is where all the previous elements, discipline, structure, risk management, and self-awareness, come together into a single, cohesive system. It is not about adding complexity, but about creating alignment between decisions, behavior, and long-term objectives. A sustainable approach is what allows trading to move from inconsistency and frustration to stability and controlled progress. At the core of this transition is long-term thinking. Instead of focusing on individual trades and their immediate outcomes, each trade is viewed as part of a larger sequence. This shift in perspective is critical because it reduces the emotional impact of both wins and losses. A single profitable trade no longer creates overconfidence, and a single loss does not lead to doubt or frustration. By understanding that results unfold over a series of trades, decision-making becomes more consistent and less influenced by short-term fluctuations. The focus moves from trying to be right on every trade to executing correctly over time. Adaptability is another essential component of a sustainable approach, especially in an evolving trading environment. Markets change, conditions shift, and no strategy remains perfectly effective forever. However, adaptation must be controlled and based on data rather than emotion. Making changes after a few losses or chasing recent performance leads to inconsistency and confusion. Instead, strategies should be reviewed periodically using a sufficient sample of trades. This allows for informed adjustments that improve performance without disrupting the overall structure. The goal is refinement, not constant reinvention. Technology plays an increasingly important role in modern trading and can significantly enhance efficiency when used correctly. Tools for market analysis, trade execution, and performance tracking can improve accuracy and reduce the likelihood of manual errors. Automated stop, loss, and take profit orders, for example, help enforce risk management rules without relying on real-time decisions. Journaling tools make it easier to track behavior and identify patterns. However, it is important to understand that technology is a support system, not a solution on its own. It should strengthen an already defined process rather than replace the need for discipline and structure. Continuous improvement is what sustains long-term growth. Trading is not a static skill, it evolves through consistent evaluation and adjustment. Regularly reviewing trades, analyzing performance data, and identifying behavioral patterns allows for gradual refinement of both strategy and execution. These improvements do not need to be dramatic. Small, consistent adjustments over time lead to meaningful progress. This approach reduces pressure and makes development more manageable, as the focus remains on steady improvement rather than immediate results. Despite all these elements, risk management remains the foundation of a sustainable trading approach. Protecting capital is the primary objective because it ensures the ability to continue participating in the market. Without effective risk control, even the most well-designed strategy can fail. Every trade must operate within predefined risk limits, and overall exposure must be managed carefully. Consistency in risk management creates stability, allowing performance to be evaluated accurately and preventing large drawdowns that can disrupt progress. The concept of a single mistake should not be viewed as an isolated issue, but as a reminder of how important discipline and consistency are in trading. That one mistake, whether it is breaking rules, adjusting risk impulsively, or acting on emotion, can appear in different forms and influence multiple aspects of performance. By identifying and addressing this core issue, improvements naturally extend across the entire trading process. Eliminating the root cause leads to better execution, clearer decision-making, and more stable results. The transition to a sustainable approach requires commitment and patience. It is not something that happens overnight, and it cannot be achieved through shortcuts. There will be periods where progress feels slow or uncertain, but consistency in following the process is what ultimately leads to results. Over time, disciplined behavior becomes more natural, and the system begins to produce more predictable outcomes. From a broader perspective, the idea that a single mistake can significantly damage a trading account is not an exaggeration. When that mistake is repeated over time, its impact compounds, affecting both capital and confidence. This is why addressing it is so important. By focusing on behavior, implementing structured systems, and reinforcing discipline, it becomes possible to break the cycle of repeated losses. The ultimate goal is not perfection. Perfection is unrealistic and unnecessary. The goal is consistency, consistent execution, consistent risk management, and consistent behavior. As errors are reduced and discipline improves, trading becomes more controlled and less dependent on chance. The principle is clear and practical. Eliminate the recurring mistake, and the path to long-term stability becomes achievable.